Hello, today we have Bruce Ogilvie, Executive Chairman of Alliance Entertainment, trading on the Nasdaq under the ticker AENT. Bruce, welcome.
Thank you, Craig. Pleasure to meet you.
Pleasure to meet you too, Bruce. Alliance Entertainment, a leader in the entertainment distribution industry. Can you briefly introduce Alliance to our audience and tell us about what sets the company apart from other players in the entertainment space?
Well, Alliance Entertainment, AENT, has the widest selection of entertainment products that we can offer any retailer, online retailer, omni retailer, or consumer. We carry movies, music, video games, and collectibles. And these are all the big superstar artists and the best movies, best streaming services, anything you can imagine, as well as any collectibles you might want to bundle with that or have that part of those entertainment offerings there.
Now, we've seen a significant shift toward digital content and direct-to-consumer models in recent years, Bruce. How has Alliance Entertainment adapted to these trends, and what opportunities do you see in the digital and DTC spaces for your company?
Yeah, there's two areas there. You have digital and you mentioned direct-to-consumer. I'll take direct-to-consumer first. It's no secret that the consumer is shifting all their shopping patterns, going to an online retailer. And you have these brick and mortar retailers or omni retailers that have physical stores. At the same time, they want to be as good as Amazon. Where we come in is we become the hamburger helper. We make them better retailers. We expand their selection. If you go into a store, their selection's only as good as what they stock there, what they carry in their DCs. But if you want to be on a level playing field with Amazon, you need that long tail selection. And that's where we come in because we have 325,000 titles we actually stock that we own, have in our building, ready to ship. So we can help these retailers, light up that buy box button on their website. They're saying available in stock and we can ship now. That's the secret sauce to us, having that big long tail selection. 40% of our business is direct to consumer. And that's where we're shipping directly to the consumer on behalf of our own retail brands that we own or all these omni retailers that we sell to. And when it arrives at your doorstep, you think it came in from a Walmart or Target or Best Buy, but the reality is it came from us because we white label the shipment and make it look like it. They shipped it, and that's us, the middleman you could never get rid of.
Now, Bruce, you were telling me offline that the background currently behind you is a partial view of one of your distribution centers. Is that right?
Yeah, this would be the top floor of a couple of mezzanines that we have, Mezz 1, Mezz 2. And this is all that long tail selection of physical media there. These are the the onesies, twosies that we order so much of as far as direct to consumer. We also have really large bulk quantities. We carry 10, 50, 100,000 of a big new release like a Taylor Swift or something like that. So yeah, we have the scale as well as the nimbleness to ship out these onesie orders out to the consumer.
Now that leads me to my next question here, which is the investments that your company has made in large-scale automation. How are they driving new efficiencies and cost savings for the company?
We've always leaned on technology. That's our strength, service technology. And the thing for technology we need is that we have to use that technology to lower our fulfillment costs. Labor, we certainly learned during COVID, how hard it was to get labor at a time there. We were open the entire time during COVID. We were considered an essential company, essential supplier. So, we had a pretty impressive time there with consumers locked up, wanting movies, music, games to entertain themselves at home. But at the same time, it was hard to get labor. And we'd found a company called AutoStore, which I call the Rubik's Cube of auto storage retrieval systems. Pretty impressive. It's worth checking out. Basically, you have all these totes stacked on top of each other, and they eliminate aisles. And think of a tote as a shelf location. Instead of the human being walking around our warehouse through the mezzanine to pick something off the shelf, the tote comes to that processor and they pick it. That automation lowered our headcount of picking vinyl from 41 employees down to 7. So it's a big labor savings for us there. So yeah, having automation is low. And if you look at our 10K RQ, and just look at the year over year, you'll see that our overall savings and fulfillment costs are down 1% because of this type of investment we made in automation.
Now, Alliance has a very strong history of acquisitions, as you know, Bruce, having successfully integrated more than a dozen companies. Give us your acquisition strategy, and I want to know, What kinds of businesses or technologies are you looking to add to your portfolio, and how do you see them enhancing your overall growth strategy?
Well, obviously, as you said, a long history of acquisitions, 20-year history there, went from 18 million to 1.4 billion. That was all because of acquisitions, and we always look for either competitors that we're looking to sell, other businesses that would complement what we were not currently doing, or customers we were not serving, and so we have a long list of opportunities there, where we could look at our current customers, current suppliers, or competitors that we compete with. And we're just looking for ways to diversify and diversify our product line, where we have the infrastructure in place with all these online retailers, where electronically they're connected to us. It's just a matter for us looking for additional companies to acquire, to give us additional products to distribute, and offer those customers there that we currently have, as well as the consumers that we sell to represent. So that's what we're looking for. As far as what we do to keep on course. Historically, we kind of use first thing we find somebody we like, we ask for the financial statements, and then we try and build the model of what's the standalone EBITDA number for this company as a standalone. And then we say, okay. And then the next thing we try and figure out, what is the working capital requirements for this business? How much working capital does it need to operate? So we call that the PEG. So we figure out what's the EBITDA multiple. What's the EBITDA? The multiple we like to use is about a 3x multiple there. And then we have the PEG. And with all of those, we can then determine, okay, we'll make an offer price of 3 times that EBITDA number, whatever that is. We'll have to set the PEG at a number which we call the 12-month working capital number, or the average working capital number is, looking backwards at what time the peaks and the low, and then convincing the seller to carry some type of paper or debt or an earnout that pretty much ensures a certainty closure with lenders. And then now, being a public company, we have the ability to offer stock, which is something we never had before. Not that we're going to go crazy with it there. It has to be accretive to our earnings for anything we buy there that makes sense there. So that's kind of our whole formula.
Now, the total addressable market for your company, it must be huge. How big is it, and how much can Alliance get of it?
Well, if you take all the categories of products we sell, we have movies, music, video games, and collectibles. You're looking somewhere in the neighborhood of total products being sold in the U.S. between $10 to $12 billion worth of commerce being sold, physical media, and of course that's movies, music, And when we say hardware and gaming, we're talking consoles, we're talking controllers, we have the retro arcades that we sell there. So we have a pretty big basket of products that we offer and sell. Us being the entertainment experts of selling entertainment, and we bring entertainment to you. So that is where we can. I mean, right now we're only currently like 1.1 billion in total revenue on a rolling 12 months, and so we still feel we have a long way to go. Our opportunities right now is the movie industry, is they are in the, I should say, the big studios like Paramount and Disney. They are looking to get out of home entertainment. When I say physical media, where they sell it to the retailers and deal with all that, we're very heavy in that area there. We want to lean in more, and we're seeing the opportunities that we can license that content and take over that distribution and be the exclusive seller of those studios. And it's just part of the transition as these large, big, IP companies with all their content. If 90% of their business is digital in the form of streaming or premium downloads of some kind, why do they want to mess around with 10%, physical media and have that infrastructure where they can just license to a third party like us? We would pay them a royalty on the sales we make, give them a small advance. Everybody would be happy in the process.
Leadership, Bruce, key to the success of any company, and especially a smaller cap company. Tell us about your team.
Well, we wouldn't be where we're at today if it wasn't for our team. We have, with all those acquisitions we did over the years there, we really acquired the cream of the crop. The industry was going through consolidation. We were part of that consolidation, of helping the industry consolidate. And you just really, find out who are the doers and the getters and who can get the job done, and the self-starters. And that's our team today. The team we have in place can operate the company. If Jeff or I was hit by a bus or something like that, or something happened there, they would pick up and just keep the company going right as it is. We wouldn't miss a beat there, because it pretty much runs itself. I mean, as we've taken on this new responsibility to being a public company and doing all our shareholder duties and stockholder duties, we're not, I didn't say we have lost focus on our business, but it's forced us to go in other areas. Well, the team could step up and do all the functions that we were doing as we do these double duties.
All right, let me just give you this last question. The essential value proposition. Why should anyone take an interest in Alliance Entertainment right now?
Well, we feel we're extremely undervalued for the amount of revenue we're doing, how much EBITDA we have. And we also recognize that probably are undervalued because we don't have enough float out there. We need to show quarters of really good performance and consistency, and we're well set up for that. There, we always knew we started as a SPAC. We de-SPAC'd. It didn't go as well as we wanted. We could have walked away from it and say, okay, let's not do this. But our ultimate goal was always to be a public company, so we'd have the ability to raise money and grow the company. It took us 20 years to get from that 18 million to 1.4 billion. We really feel as a public company, we would have the ability to raise capital and grow the company and grow at a much faster rate than we did the first 20 years. So the next 5 years, hopefully we can repeat what it took us 20 years.
That's a great story. Thank you for sharing it with us today.
Thank you.